One now?
Yes.
Okay. So just do this very quickly, okay? Because I assume that you have done this at home. All right. So I will just go through this very quickly. So some of the transactions carried out by some company during the first month of company operations are listed below. You are to determine the dollar effect of each transaction on the total asset, total liabilities, and owner's equity of some company. Use the symbols positive for increase, negative for decrease, and NC for no change. An answer is provided for the first transaction to serve as an example. All right, so we have issued capital stock to Don Sang. Don Sang is the company lah, in exchange for his investment of 200,000 in the business. So for that, you have the total asset increase in what form? Which account increase?
Cash.
Cash increase, so cash is in your asset, so cash increased by 200,000. No change in your liabilities, and your owner's equity share capital increases by 200,000. All right. So the second one, you have a computer. You purchase a computer for the business for 5,500 cash. So what happened here?
Decrease in cash.
Yeah. So there's no change actually in cash. Do you agree? What did I say? No change?
Because he purchased a computer.
Yeah, because you purchase a computer, so your computer increases, is an asset, but at the same time, your cash is also an asset, decreases by 5,500. So you have an increase in asset of 5,500. You also have a decrease in cash, all right, which is also an asset by 5,500. So in this case, your total asset, there's no change, isn't it? Do you agree with that? You can have under your total asset plus 5,500 in the form of computer, but you minus 5,500 in the form of cash. So your total asset, there's no change. So your total liability also no change, and your owner's equity also no change. Okay? And then you borrowed 20,000 from the bank. Because this now is, can I write something here? I do not know. Can I write? All right. Here is no change. Tak boleh lah. I tak ada pen. Okay. And then you borrowed 20,000 from the bank. So now your asset increased by 20,000. Your liabilities also increased by 20,000. Owner's equity, no change. You clear? Your purchase office furniture, office furnishing at a price of 4,200. You pay 600 cash and the balance in 2 installments. So you have increase in your office furniture value of 4,200, but you also have the decrease in cash 600. So there's a plus minus there. Plus furniture, office furniture 4,200, and then minus 600 cash, but your total liabilities increases. The difference is 4,200 minus 600. How much is that? 3,000. 3,800. 3,600.
800.
Huh? 4,002. You pay 600. So balance account payable. How much your accounts payable increase?
3,600.
3,700. 3,600. All right, because the balance 600 paid in cash. So 3,006 plus 3,600 jadi 4,200, isn't it? So your liabilities increase by 3,600. Your asset net increase is also 3,600. And then you pay 1,008 balance of the furniture. So means that your cash decreases. So your office equipment, office furnishing, no change. But your cash decreased by 1,008. And then your liabilities will also decrease by 1,800. And then you sold monitor, cost you 250 for 300. So now you look, right? So you purchase the monitor that cost you 250, but you sell 300 on credit. So are you making a profit or loss?
Profit.
Profit. How much?
50.
50. So that 50 increases your owner's equity. Yeah, whenever you have extra, in this case, profit, so you will have a increase in owner's equity. So how to record this? So you sell on credit, so there's no cash received, but your monitor, in this case, what is your monitor? I think monitor, computer, is it? Part of your computer. So you reduce your computer 250. And then you also have your accounts receivable, because you're going to receive that money in the future, right? How much? 300, right? So now you have debit account receivable 300, credit your monitor or your computer to 50. So now you have increased the profit, you record that under equity. So the increase of 250, the increase of 50, the profit, record that as an equity. So you're going to credit or plus your equity account. You get that? So if I were to write, how do I write here? Okay. If I were to write here, can I write? I cannot write. Why can't I write? Okay. Can I write? Please let me write, please. I cannot write. Okay, let me try this one. Okay, so for your, which one? For your D, is right, not for D. Cannot write. Why am I not? Okay. So here, monitor, right? Okay. This one, you have your monitor less monitor. Now delivery. Monitor minus 250, but then you have accounts receivable, you have plus 300. So here you also have a credit plus, what do you call that? Owner's equity. You plus, what is it? Owner's equity plus of 50. Right, so from here you see that you have, on the debit side you have net of 50, on the equity side you also have net of 50 increase. Yeah. Okay, and then you collect it from accounts receivable. So when you collect from accounts receivable, you will have your, what do you have? You will have your, reduce your accounts receivable, right? Reduced by 150, and you receive cash of 150, right? No other accounts are involved, so net increase in asset is 0, right? So you have both on the debit side and credit side from the total assets. And then you bought a small truck. Business paid in full. So when you have this, what will be your so this is your, what do you call that? Truck or motor vehicle, right? Motor vehicle plus 29K, and then you paid in cash, so cash minus by 29K. So that's how you record that in your this table, right? So you just want to see the plus minus of the account. Okay. Anyone not clear? Anything that you want me to clarify? Shaza. Who is Shaza? Okay. All right. Next is, where is the next one? I thought I had two just now. Okay, this one. Can you see this? Oh,
Yes.
okay. I'm not sure. Is this in the... Mana dia ni? Okay. Okay, now you have cross-country truck. So you are given the accounts. You are indicate the proper accounts to be debited or credited. So just now it's just a plus and minus, but this one you have to identify the accounts and whether you want to debit which account and which accounts to be credited. So you have trust are purchased by making 30% cash down payment and issuing a note payable for the balance of the purchase. So debit in this case, you're going to have you purchase a truck, which is a motor vehicle. You have item number 5. Okay. You are going to debit your truck account. Why is it not? Here you go. Number 5. And then you are going to debit. Accounts to be credited is your cash. Where is your cash? Cash is account number 1. Credit your cash because you pay cash. And then what more? Credit your note payable. What's your note payable? Number 22. Are you clear? Right. So that is when you purchase a motor vehicle truck. So you have debit your truck account. And then you credit because you pay cash 30%, you credit your cash account, and you also credit your note payable, which is a liability. Fee is received in advance for rental truck for a future period. So this one, all right, is actually what we are supposed to cover today for your adjustment. All right, so I leave it there first. You purchase large quantity of office supplies on credit. Office supplies is an asset. So you have asset number 3. So asset number 3, and then purchase by credit. So credit, then you have your accounts payable. Is it? So what is your accounts payable? Accounts payable is number 21. Okay. Bought a 3-year insurance. So again, this one is your accrual today. All right. So let's go into the topic today, which is your adjustment. All right. Then we can go back to the tutorial that I give you. All right. So adjustment. I believe that you have actually looked into this topic before, adjustment. We are actually looking at what is an adjustment. It's not an error, right? Adjustment are not errors, but adjustment are to recognize your revenue and your expenses incurred for the current financial period. All right, so we are going to look at why you have to do adjustments for your revenue and expenses. All right, adjustment occur when we apply the relevant concept and assumptions in the preparation of financial statements. So what are those? We have the principle where we have to record your revenue. All right, so revenue, remember, is part of your honest equity. You have revenue should be recorded or recognized at the time goods are sold. So we talk about 2 types of business that actually sell goods or business that actually perform services. So whenever you sell goods, then you have to recognize that sales as your revenue. Or when you perform your services, then that services is also rendered. So that is also when you recognize your revenue. So throughout your business period, you're going to have a lot of expenses. So you're going to record the period has the expenses are used up. All right. So later we look into how these expenses are recorded. Yeah. Okay. The accrual basis of accounting. So the main reason why we have an adjustment are because accrual basis accounting. All right. So accrual basis of accounting is consider that we are going to record revenue when is a revenue is sold, means that when goods are sold or when services are rendered. All right, it doesn't matter about the cash, whether cash has been received or not. So the problem here is that cash is received or paid. All right, sometimes you receive cash, receive or paid during the period, but the goods has not been sold, right? Or the expenses has not been incurred. So that's why we have to do some adjustment, because we only want to take the revenue and expenses for the current period. If it's for the future period, then we have to do adjustment. Yeah, because our concern is only the income and expenses for the current period. So for example, here we're talking about the current period is from 1st January 2015 until December, not December 1st, it should be 31st of December 2015. So the period is for 1 year, so from January. So any revenue or expenses during that period only that should be recorded, right? So we can have, for example, a scenario whereby cash is received during the current period, but it's meant for revenue or expenses in the future period, right? Or you can also have a scenario whereby you record revenue and expenses in the current period, but the cash will only be received in the future, right? In the future accounting period. So that's why, because of this, all right, later then we have to do adjustment, right? So under accrual basis, revenues are recognized when earned and expenses are recognized when incurred. So when you want to talk about revenue earned, all right, it's either we're talking about goods when goods are sold. So goods are sold means that it doesn't mean that you receive cash. You can sell goods first, but you receive cash later. Right? So for example, if you sell goods on account, so you make sales already, it's a revenue because you have sold your item, but you have not recorded your cash because you have not received your cash. So even though you do not receive cash, but you're going to recognize your revenue because why? Revenue earned. Because why? Goods sold or the services has been rendered. Similarly, when talking about expenses, all right, you're going to recognize your expense when it's incurred, not expense when it is paid, right? Sometimes you incur the expenses, but you're going to pay the expense later in the future, right? So you have to recognize whatever expenses that incurred, even though the expenses have not been paid. Yeah, so that's why we do have to take into account the adjustment. So the cash basis revenues are recognized when cash is received and expenses recorded when cash is paid. So that's why we call about cash basis accounting. However, this cash basis accounting, when we record when cash is received, when payment is made, right, is not acceptable under the GAAP. What is GAAP? General accounting practices. Yeah, it's not accepted, the cash basis. So we have to go for the accrual basis, whereby revenue is recorded when it's earned, expenses recognized when it's incurred. Right. So the adjusting entries. An adjusting entry is recorded to bring an asset or liability account balance to its proper amount. Right. So what are the adjustments? Number one is that when you receive or you paid or receive cash before expense or revenue recognized. All right, or you pay or receive cash after expense or revenue recognized. So what happened here is that we're going to introduce you the term prepaid account, prepaid expenses, prepaid expenses and prepaid revenue. All right, or you have the accrued expenses and accrued revenue. Yeah, so paid or receive means that if you're talking about the first one, okay, paid or receive cash. So you receive cash, but the revenue or the expense, the revenue has not been earned, but cash has been received. Or you receive cash before your expenses incurred. All right, so that is what we call a prepaid. You paid in advance. All right, or the other one is accrued, whereby you only make payment or you only receive cash after the revenue or expense has been recognized. All right. So because of that, do we have the prepaid expenses or we have the unearned revenue? All right. Prepaid expenses means that you receive if you make payment for your expenses now, but it's for future expenses. You make payment in the current account for future accounting period, right? Or you receive cash for the revenue which has not been earned. That's why it's called unearned revenue, all right? Or we call it as a deferred revenue. I prefer unearned revenue because that means that, okay, revenue has not been earned, but cash has been received. Yeah. The other one we talk about is the accrued expenses, meaning the expenses incurred, but you are going to pay that later. Similarly, revenue has been earned, means that you have sold the goods, or you may have performed the services, which is that you have not received the cash. Cash will be received later. So the time difference here make the reason why you have to do adjustment. All right. So for our example here, okay, before we go into the example, any question on this? Anyone?
Madam,
Yes.
I want to
Yes.
ask that on the slide, what is the including depreciation?
Depreciation, yes. But depreciation is it does not involve cash. Yeah, because you don't pay for your depreciation. But it's part of an adjustment. All right, so we are going to have what we call a contra asset later. So the adjustment is for the adjustment for depreciation, but it does not involve cash because you don't pay for your depreciation. All right, we look into that later. Other question? Tak ada. So far okay, yeah. So you must remember that you have prepaid expenses, prepaid revenue, or not, salah. Prepaid expenses and unearned revenue. Prepaid expenses means that you paid for expenses in the current accounting period, but the expenses will be incurred in the future accounting period. Right? So you may pay in advance, right? Unearned revenue, similarly, you receive cash for the services or goods which has not been performed. You have not earned the revenue, but you have received the cash. For example, all right, this one very rare, but when you sell goods, right, you have not sold the goods, but the customer has actually paid for the stock, right? Paid in advance. So that's what we call unearned revenue. Right? Accrued expenses means that expenses have been incurred, but you have not paid. Accrued revenue has been earned, but not paid. Okay. For our example, we shall use the following financial period. We have financial period of a company year ending 31st December 2021. So the financial year start from 1st January 2021 to 31st December 2021. Is that clear? Yeah, so we have 1 year financial period start from 1st January to 31st of December. So let's look into your prepaid expense, right? So adjustment, we call it as a prepaid expenses, means that we make payment for the expenses first. You pay rental expense on 1st September 2021, right? So you make payment of rental for 3,000 ringgit for 6 months. So kalau you tengok your year end is 31st of December, but you make payment of 3,000 for your rental expense for 6 months. So if you make payment on 1st September, for 2021, you have September, October, November, and December. So 4 months only for 2021. The other 2 months is January and February, which is in 2022. So this is your current accounting period. The other 2 months is the future accounting period, right? So because you pay for 6 months, so you have to you have to recognize which one is for the current accounting period, which one is for the future accounting period. So rent expense is paid for 6 months from month of September to February 2022. So how are you going to do the adjustment? From that 3,000, you know 4 months is for 2021, 2 months is for 2022. So identify the current period expense. All right, for example, in this case, from out of the 6,000, you know that 4 months is to be prorated. 4 months is for 2021, 2 months is for the others. Right, so prorate according to the months incurred for the current period, which is the 4 months. So how you prorate? The 3,000 for 6 months times by 4 over 6 months. So you know that from the 3,000, 2,000 is for the current period, right? And the balance would be for the following period. So recognize the expense for current period. So when you receive, all right, you receive cash of 3,000. So you have to record your cash because that is the amount that you receive. You cannot have cash 2,000 because it's wrong. You receive 3,000 cash, right? But that 3,000 is paid for 6 months. So you're going to recognize your rental expense. You are going to debit your rental expense 2,000. Okay. So when you receive this, all right, how is your journal entries, right? So look at the rental, prepaid rent. So we have an account which is called prepaid rent expenses, right? Prepaid rent, so you debit your cash because that is the amount of the prepaid rental. Prepaid, why debit? Because prepaid rent is in this case you make payment, right? You make payment, isn't it? You pay, so that is your asset. Yeah, because you pay in advance, so the prepaid expense is an asset. So that's why you debit your cash. Okay, let's look at this. Don't look. Okay, prepaid rent expense is 3,000 because it's an asset. All right, debit your prepaid rent expense, credit your cash 3,000. Kenapa you credit your cash? Because you pay for your rental, right? You pay for your rental 3,000. That's why you credit. But then you're going to recognize as of 31st of December. So when you make payment on 1st September, this is your recording. Prepaid rent expenses 3,000 and cash 3,000. But when you have the year end 31st of December, then you're going to recognize how much is my rental expense from September to December. So you're going to recognize the 4 months period. So you're going to debit your rental expense 2,000. Then you are going to reduce your prepaid rent expense, the account that you first created just now. So now the amount is reduced by 2,000. So you debit your rental expense. Now you recognize your expense, but you reduce your asset. Previously it was 3,000, but now it's reduced to 2,000. So your rental, your prepaid rent expense is an asset. All right, so it means that you still have a balance of 1,000. 3,000 initially you open up the account, right? Mana dia? All right, 3,000 you open up the account for the rental, and then at the end 31st December you credit the account 2,000, so you have a balance of 1,000. Okay, all right. So that is a prepaid expenses. What happens is that means that prepaid expense, you pay your expenses now for the following periods, right? So you have to recognize that. For the prepaid revenue, it means that, right, also known as unearned revenue. Okay, so what happens is that you receive rent revenue. So in this case, receive rent revenue of 3,000 for 6 months. So rental revenue is seen that you provide services of rental. Right, so now you receive rent revenue. So someone paid you in advance for the rental of a building, for example, for 3,000. Yeah, so you receive 3,000 ringgit now for the rental of the 6 months period. Similarly, you identify the current period, which is only for 4 months, which is September, October, November, December. There are only 4 months here. So the balance 2 months is for the following or the future accounting period. So identify the current period's revenue, and then you prorate accordingly, and then you recognize the revenue for the current period. Right? So here prepaid rent revenue is a liability. Right? It's a liability. Why? Because when you receive something which it does not belong, you have not earned the revenue. Right? That's why namanya unearned revenue. So it's a liability to you. So liability is a credit balance. So that's why you have this prepaid rent revenue of 3,000 is a credit, right? And then you debit your rent revenue at the end of the, when you have your 31st of December. Okay. So when you receive the cash rent revenue, you receive cash 3,000, you credit your prepaid rent revenue is or unearned revenue. This one is a credit because it's a liability. Then when it comes to 31st of December, you debit your rent revenue 2,000 and credit your rent. So here is actually, it's not, let me see if I can, rent revenue here, it should be December, right? December 31st. So you only do the revenue later, right? Okay. So that is for your prepaid revenue. You receive cash for revenue, unearned revenue. And then we have the accrued expense. Is easier because you incurred the expenses but you have not paid. All right, so you just rental accrued for 6 months. So you have rental accrued. So for 6 months, similarly from September to February. Okay, so you are going to apportion, in this case, rental expense outstanding for 6 months, 3,000 for the month of September. But why is it here 2 months only? Current period prorate for the month for the current period. Why is it current period is 2 months only? Why? Oh, hold on. Why look at it wrongly? You end it berapa? Example, hold on let me check. The example here, it says that year end is 31st December 2021. Right? So this case you receive, so that is for 2022, correct? But here, prepaid revenue 2021. So this one is correct. But why here accrued expenses?
Maybe because it's from 2020.
Was it 2020? Oh, I see. Because accrued adjustment, accrued expense, 1st September 2020. Hold on. Hello? Salam. Sorry, I'm dalam kelas sekarang. Cari. Kenapa pasal apa ni? Siapa ni? Dia siapa ni? Oh, I see. Nanti I call balik boleh tak, Izzah? Pasal dia punya dapur tu I call balik sebab I tengah kelas kan. You ada satu lagi nombor Asyari kan? Belakang 4422. Tak apa. Nanti I call. Alright, thank you. Okay. Apa ya? Okay, dia buat pada 1st September. Oh, okay. The expenses incurred in since 1st September 2020 until 28 February 2021. So you have to recognize the 2 months period first too. Right? Because now you're talking about expenses that have been incurred but have not been paid. So what they do is that the 2 months period is in 2021. So you allocate that for 1,000, prorated that. So how do you record? Rent expense, accrued rent expense. Oh, this one is from the previous account. Oh, confusing sikit lah kat sini. Right? End of chapter dah? Ya, betul. Okay, I rasa I tak nak pakai ni. I will give you another PowerPoint lah. Sebab I rasa it's not fair. Let me, hold on ya. Let's see. Ini topik 4 kan. I letak lagi satu lah. Tak puas hati dengan that presentation. Okay. Okay, I've shared that new PowerPoint. Okay, let's look at this PowerPoint. I think that this one is clearer. Right, so let's go it very quickly because it's just a revision, but the how it's presented is a bit different. So adjusting entries are needed whenever revenue or expenses affect more than one accounting period. Every adjusting entry involves a change in either a revenue or expense and an asset or liability. So it will involve that revenue and expense, asset or liability. There are types of adjusting entries: convert asset to expenses, number one; convert liabilities to revenue. So convert asset to expenses is just like when we did your prepaid expenses just now, right? Converting liabilities to revenue is when you receive your unearned revenue. And then we have accrued unpaid expenses, accrued uncollected revenue. All right, converting assets to expenses, all right, you pay cash in advance for expenses. So you do adjusting entries at the end of the current period. So you're going to recognize portion of asset consumed and reduce balance of the asset account, right? So here example, converting asset to expenses. You have $18,000 insurance policy coverage for 12 months. So you make a payment of 18,000 insurance. So remember that when you talk about insurance, normally you have to pay one amount for several periods. Yeah. So normally it will involve more than one accounting period. So 18,000 for 12 months is 1,500 per month. So you have made payment. All right. On overnight auto service, purchase a 1-year insurance policy for 18,000. So 1 year insurance policy, you have made the payment. All right. So how are you going to record that? So this one they call it as an unexpired insurance, or what we call prepaid insurance. Boleh tak I betulkan? What happened? Where is it? Where is mine? Okay. I can't do that because it's a picture. We call it as a prepaid insurance, and then you pay for your insurance 18,000. That's why you credit your cash on 1st of March. Okay. Apa jadi? What happened? Okay. And then, all right, remember that this one is made payment on 1st of March. So you're going to record unexpired insurance or prepaid insurance. Can you write down? Prepaid insurance of 18,000, and you're going to credit your cash of 18,000 because you make payment for the insurance. And then as the end of the month, all right, in this case, you got 1 month. End of the month, March 31st, you're going to recognize insurance of 1,500. So in this case, the example is at the end of the month. So every month you're going to credit 1,500 to recognize the expenses. Right? So in this case, they debit their insurance expense for end of the month. Monthly expense is 1,500. So at the end of each month, they're going to debit insurance expense, and they're going to credit the prepaid insurance. Yeah, prepaid insurance is at asset. All right, balance sheet, you have the unexpired insurance. So initially it was 18,000, but end of the month. So 1 month only. So you have utilized 1,500. So the balance of the unexpired insurance or the prepaid insurance is 16,500. In your income statement, you're going to recognize the insurance expense, which is an expense account of 1,500. All right, and then we also have the depreciation. I will skip depreciation first. All right, I will skip depreciation. I will come back to depreciation later. Right, now the second one is converting your liabilities to revenue. Okay, this is when we have transaction, you collect cash in advance of earning a revenue. So you have not performed the revenue, you have not sold the goods, but you have received cash in advance. All right, similarly, you have to recognize the portion of revenue and then reduce balance of liability. So when you receive cash, all right, for revenue that has not been performed, the unearned revenue is a liability. Right, so example here, you convert liability to revenue, 3,000 rental contract coverage for 3 months. Right, 3 months means that 1,000 monthly rental. So that is from December 1st until February 28th. So 3 months, December, January, and February. On December 1st, Overnight received 3,000 in advance for a 3-month rental contract. So in this case, the company received cash for the revenue, rental revenue. But because you have not actually earned the revenue, that's why you're going to debit your cash credit, your unearned rent revenue, 3,000. Right, collected 3,000 in advance for your rent. Remember that the unearned revenue is a liability, that's why it has a credit balance. Over time, the revenue is recognized as it is earned. So you have December 31st unearned rental revenue of 1,000. Then you're going to credit your revenue. Why you credit now after December 31st? Now only you recognize the rental revenue. So after 1 month, now only you earn your revenue. So that's how you recognize your revenue. Revenue is again a credit because that increases your honest equity. Unearned revenue is a liability. Why is it debited? Because now the unearned revenue reduced by 1,000 because you already earned the rental revenue for month of December. Right, balance sheet item is the unearned rental revenue is a liability. Right, initially it was 3,000. End of the month you earn 1,000. So the balance of the unearned rental revenue is 2,000. For the same period, for the month of December, you're going to recognize your rental revenue of 1,000. It's a credit balance because rental revenue is a revenue account, increase your honest equity. Okay. Then you have accrued unpaid expenses. So where is you have the prior periods, and then you have the current periods, and then you have the future periods. What happened during this period is that at the end of the current period, you have incurred expenses, but you have not paid for it. So that expense become a liability, right? Pay cash in settlement of liability in the future period. So example here is that on December 31st, overnight owes wages of 1,950, payday is Friday, January 3rd. What happened? Overnight owes wages. So you means that you should have paid the wages to your employees, but as of 31st December, you have not paid them. But have you incurred the expense? Yes, you have incurred the expense as of 31st of December. So now it's a liability. But you must recognize the expenses. So you debit your expense. In this case, wages expense 1,950, but then the amount is become a liability. So you call it as a wages payable that you have to pay in the future. Right, so normally this common because wages normally you pay late, a bit late. All right, it's not that today you perform, today you do your job, immediately your boss will pay you. Yeah, normally boss will pay at the end of the month, so it will take some time. Right, so in your balance sheet you have a wages payable. So in this case it's 3,000. Why is it 3,000? Initially it was 3,000, but then you recognize 1,950. Yeah, wages payable. So initially it was 3,000, but then you recognize 1,950. This one is for your unpaid expenses. Entry for January 3rd when you make the payment. What is 447? 3 days punya wages. Right? Accrued 1,950, which you have recorded just now, but now it's debited because now you pay your wages 2,397. How you get 2,397? January 1st, 2nd, and 3rd, you create 3 out of 31 days. Right, 3 out of 31 times by 1950, you should get 447, isn't it? Let me see. 3 out of 31 days times by 1950, 188 times 3. Salah. 3 over how many days working? Weekly payroll, December 30th. December 30th. 30th, 31st, 1, 2, 3. Then here 5 days. 5 over 31 times by 1950. How do you get 447? Anyone? I got 314. Right, for January, I'm not sure how they get that 447. I kira tak dapat. I got 314. Anyone got 447? Never mind. Okay. Recognize revenue earned but not yet recorded and records available receivable. Collected. So this one is the uncollected revenues. You have performed you have earned your revenue, but you have not collected your cash. Right? Overnight half of its maintenance agreement, the 1 month fee of 1,005 is to be paid on 15th day of January. So 750 repair service, the 1 month fee 1,005 is to be paid on the 15th of January. So that's how you record debit your account receivable as of 31st December, because you're going to receive that on 15th of January. So it's the 750 you record debit because that is your asset, your account receivable, and then your repair service revenue. Now you earn, even though you have not received the cash, you have actually earned the revenue as of 31st of December. So that's why you credit your revenue account. Right? So at the end of the year, you will have your account receivable balance of 750, and you also have recognized your revenue of 750. All right, and the 750 later, when you make payment on January 15, you're going to debit your cash because you're going to receive it. Do you remember your account receivable just now? So you receive 1,005. But then you are going to reduce your account receivable 750, and your service revenue for January is also recognized now. Income tax adjustment. Okay, materiality. Alright, an item is material if knowledge of the item might be influence the decision. So sometimes, alright, if company buy their office supplies, for example, in bulk. Alright, so rather than they buy one pencil, so they buy a box of pencil or boxes of pencil. Right, for stationaries, for example, these are office supplies. So they buy in bulk. So then you also have to allocate, all right, when you first purchase, and then over the period you have to recognize how much is your office supplies expense. So here office supply, there are two. One is your asset when you make purchase of your office supplies, and over the period you're going to reduce your office supplies, but you're going to recognize that as your expense. All right, so this is the summary effect of the adjusting entries. Converting asset to expenses, convert liability to revenue, accrued unpaid expense, accrued uncollected revenue, what kind of account are actually affected. All right, so okay, let me check on the depreciation just now. All right, so depreciation just now, siapa yang tanya pasal depreciation tadi? All right, because depreciation is because we have asset, which is for example, you have your motor vehicle, your office equipment, your building, all these are supposed to be depreciated. Yeah, is the systematic allocation of the cost of depreciable asset to expense. So from the asset, you convert that into expense. Right? So upon purchase of the asset, you're going to debit your fixed asset, credit your cash. But throughout the period of usefulness, all right, you're going to consume the asset. So you're going to recognize how much is the expense from the asset, right? And then you're going to have the accumulated depreciation account rather than, because you don't pay for your depreciation. So that's why we are creating what we call accumulated depreciation account. It's a contra account, yeah. So for example, here it's just an estimate that you purchase a building that can be used for 240 months for 36,000. So using a straight line method, you are going to apportion, allocate 36,000 over 240 months. So that is 150 per month depreciation, right? So you're talking about 150 per month. Then if you're talking about per year, do times by 12. Right, so depreciation is an expense. You're going to debit your expense and credit your accumulated depreciation building. So the accumulated depreciation is known as a contra asset. Yeah, so that's why it's a credit. Asset is a debit, contra asset is a credit account. So this amount, the accumulated depreciation, will be deducted from the building itself. Yeah, so you have two types of account here. We have the building, which is the asset. And then you have the accumulated depreciation, which is the contra asset. Okay, so two accounts there. The account depreciation expense is a profit and loss item because it's an expense. Yeah. So overnight depreciation is 12,000 of tools, equipment over 60 months. What is the monthly? 12,000 divided by 60 months, you get 200 per month. So that's how you record, debit your expense, credit your accumulated depreciation. Right, so how are we going to recognize the value, the net book value? Building, see, minus accumulated depreciation. So you have 36,000 is the value of the building when you first purchase, but over the period, you minus your accumulated depreciation. In this case, the accumulated depreciation is 1650, so 34,350 is what we call net book value of the building. Similarly, for tool and equipment, you have 18,000, but you less your accumulated depreciation for tool and equipment 2,200, then you have 15,800. That is what we call cost minus accumulated depreciation equals to the book value of the asset. All right, so that is on depreciation. I know that this one is a bit theoretical, so let's look at the tutorial. I've shared with you tutorial on this. Where's the tutorial? Okay, let's look at the tutorial. Okay, can we do this together?
Yes.
Okay. Hold on, yeah. All right, adjusting entries are prepared. Is it before financial statement and after a trial balance has been prepared? After a trial balance has been prepared and after financial statement are prepared, after posting but before trial balance, anytime an account sees fit to prepare the entries. So which one should be? Remember that the adjustment is done at the end of the period, right?
It's 3 o'clock.
At the end of the period, but before your financial statements. So normally you already have your trial balance and then only you have the adjustments, then you come out with your financial statements. Right, so whenever there's a question on adjustment, normally you'll be given the trial balance. From the trial balance, you take up the adjustments entries, and then you come up with a financial statement based on the adjusted trial balance. So the answer should be A. All right, adjusting entries are generally made daily. No. Assign revenue to the period in which they are received. No. Revenue is recognized. Fall into one of two categories? No, there are four. Are needed whenever revenue affect more than one period. So the answer should be D lah. Right? Okay, so that is the multiple choice question. Let me see if we have. Okay, what about number 40 here? Bagel company estimate depreciation on interval to be 578 for the year. Company should make the following adjusting entries. Which one? A, debit accumulated depreciation, credit depreciation expense. B, debit depreciation expense, credit automobile. C, debit depreciation expense, credit accumulated depreciation. D, debit automobile and credit depreciation expense. So A, B, C or D?
C.
C.
Right? C, it should be debit your depreciation expense and credit your accumulated depreciation. Very good. What is an accumulated depreciation? A, B, C or D?
C.
Again,
C.
accumulated depreciation. It should be C. It's a contra asset account. Which of the following statement regarding depreciation is correct? Depreciation is an exact calculation. Wrong. Depreciation is only an estimate. Correct. Of the decline in value. Correct. Depreciation is only recorded at the end of the year and never over a shorter period. Wrong. It could be on a monthly basis. Yeah. Management must know the exact life is wrong. Right. It's just based on estimate. So the answer should be B. The entry to record depreciation is an example of adjusting entry to a portion. What? Unearned revenue, liability, or to record unrecorded revenue? A, B, C, or D?
A.
It should be A because remember that we have asset, then you are going to allocate the cost of the asset over several period of years or months. Yeah, so that's why the answer should be A. Alright, mana soalan? Okay, this one. Okay. So this is an example of, what is this? Okay, let me check. Dia tak nak buat screen. Account receivable. Okay, I have put that. Okay, let's see. What you are required is that listed random numbers indicate proper accounts to be debited and credited. Example, when you pay rent on the building for the current period, debit, of course, you have to credit your cash. Number 153 is rent expense. So in this case, it's very clear because it's for the current period. All right. So when it's current period, then you don't have to do adjustment. No adjustment. So you just record into your rental expenses. But then, okay, note number A, receive an advance payment from a client for services to be rendered over next 6 months. So what will be account affected? You receive payment. So of course, debit your cash. But what are you going to credit?
Unearned fees.
Note number, account number?
24.
24. Unearned fees. This one, yeah? You're going to debit your cash, credit your unearned fees because why? You receive cash but for services that have to be performed in the future. To be rendered over next 6 months. Very good. Paid salaries to employees. This one very straightforward. So you debit your salary. Do you have salary account? Where is salary?
It's 51.
51, yes. Salary expense. Debit your salaries and credit your. When you pay salary, pay by what?
Cash.
Cash. So credit your cash. Note number 1. Account number 1. Is that clear? All right. Then you bought a 3-year insurance policy and paid in full. When you pay in full, of course, you credit your cash, but your insurance, you're going to have the insurance. I think it's a prepaid or
54.
unexpired insurance, note number 4, account number
Oh,
4,
okay.
right? Unexpired insurance. So this is when you first make the payment. So you have not allocated the expenditure yet. So you record that unexpired insurance, your asset, debit, and credit your cash account. Perform services for a client, receive part of fee in cash, remainder to be collected in 30 days. So in this case, services have been performed, so revenue earned. Right, so what kind of revenue is this? Service for client, revenue, where is it? Revenue.
41 kan?
Sorry?
41.
41, fees earned. Is it fees? I think it should be fees earned because it has no other revenue account. All right, fees earned to be credited. Why credit fees earned? What is the type of account? Fees earned.
Revenue.
Revenue account. So revenue increase your honest equity. That's why revenue is credited. All right, and then debit, of course, you debit your cash, you receive part of fee in cash. All right, disebut fee kat sini ya. And then the balance is your account receivable, also debited because account receivable is also your asset. Purchase office equipment, paid part in cash, balance in 60 days. So you have office equipment, asset, account number 5, debit. You pay cash, credit your cash, and then you also have credit your accounts payable. Yeah, note number 22. Okay, so try to do this to this example, right, and see if you have any other. Okay, let's look at this. Another one, I will just screenshot this question. Lama, tak cukup panjang. Let me see. Do we have that? Can you see that clearly in your WhatsApp? Okay. Here, actually this one is, I also given this in the Google Classroom. All right, you adjust e-books
Madam?
each month. Yes.
Madam, the before slide, there was the F, number F, which is purchases a large quantity of office supplies on credit.
Okay. So in
Madam,
that
what?
case, when you first
Yeah,
purchase, you debit your office supplies, credit your
yes,
accounts
yes.
payable. But over time,
Madam,
okay,
why don't it say office supply expenses?
not yet, because first you have to record that as your asset because it's an asset when you first pay. Right, office supply you're going to use over a period of time.
Okay, okay, okay,
All
madam.
right,
Thank
so
you.
over a period of time, then only you're going to recognize that as an expense.
Okay,
All right.
okay,
Okay,
madam.
cool.
Yes, yes, madam.
Other question?
Not yet, no.
Okay. So here you have, okay, you have the trial balance before adjustment, right? 39 cash, account receivable. So what I'm suggesting you, and then given a trial balance, then you have all this adjustment and month end adjustment, consulting fees received in advance that were earned in January, and then company paid advance for 5 months advertising in professional journals, and then supplies amount to 2250, Equipment has an original estimated useful life of 4 years, and corporation is subject to income tax of 25%. So, okay, please, okay, please ignore item number E. Right? Ignore item number E. We are going to do A, B, C, D only. And the question asked here is that after the proper adjusting entries made, what is the balance in the unearned consulting fees? Compute the amount to be reported in January income statement for the following: advertising expense and supply expense. What is the book value of the equipment at January 31st after the adjustment? And then using that information, compute the amount net income or loss to be shown in the January income statement, net income for January. Right, you also have the other question, right? So I will, in the next class, is already 3:11. All right, what I want you to do is that I want you first, all right, take note of this. Okay, let's look at this question first. All right, given this transaction, can I copy? I cannot. I want you to put this, your trial balance information, put into your financial statement. All right, I want you to prepare statement of financial position, statement of profit and loss, statement of retained earnings. So you have all these items: cash, account receivable, supplies, prepaid advertising. So I want you to put that into the respective financial statements. I want to see whether you know which accounts belongs to which statements. Can you do that? Based on the financial trial balance first. Do you get what I say? I know.
We must transfer to SOPL and SOFP.
Yeah. Transfer that first before you do the adjustment. Right? Because I want to show you how the adjustment will be reflected in the accounts. How do you want to do that? Let's try to do this together if you have enough time. Okay, let me see. I'll do that in Excel. Okay, what is that? We have, let's do this very quickly. Let's have a statement of financial. What is this? All right, let's do this very quickly. What do we have? Okay, you shop. We have a cash. How much is the cash? Let's put it as 39,645. 39,645. Okay. Okay, then accounts receivable, I just put it like that. How much is that? 27,000. Then we have your supplies. How much is it? 3,375. So this is how I want you to do first. Prepaid advertising. Remember that here, all right, I want you to put this. These are your assets. Okay, come on board. You have prepaid advertising. How much is it? Prepaid advertising. Come on. What is it? 7560. And then you will have equipment. 64,800. Then you have accumulated depreciation for your equipment. How much is that?
22,000.
Minus 22,500. Am I?
Yes.
Okay. Then we have unearned. Okay, unearned consulting fees is what? It's already your liabilities. Unearned consulting fees. Unearned fees kat sikit. How much is unearned? 17,500. What else? Income tax payable. 15,850. 840.
40.
Okay. And then we have capital stock. That is already your owner's equity. So when you look into the item in the tribal, you should know where it falls under lah. Common sense apa benda tu? Okay. What is that? Capital stock. How much is it? 18,000. Then I have retained earnings. Retained earnings is 23,850. Okay. What else do I have? I have consulting fees. So that is already my statement of profit and loss. Okay, that's your common board. So I have consulting fees. And then I have salaries. Utilities. Then I have rental. How much is the consulting fees? It's 28,800. My salaries is, I got it wrong. This one is 78,570. 78,570. Salaries is 28,800. 1080. 4050. Okay. So would I get a balance here? Let me see. Here is total asset is, right? Here is, how much is this? Tak sama. Where did it go wrong? Because I have not included my what? My profit minus sum of my expenses. 44,640. I put it here. Profit. Don't play. Right? So this very quickly. So when I put all that into my profit and statement of financial position, I have all the assets. Total assets is 119,880. My liabilities is my unearned fees and income tax payable. Right? So this one is total liabilities. This is my total owner's equity. This one is not here. Command F, command B, right? Command both. So this one is actually sum of this one. Okay, so that's how I get my liability 33,390, but my owner's equity is 44. So how do I get this profit? Profit here is actually computed based on my statement of profit and loss. So I have a consulting fees revenue of 78,570. And then now I have a salaries, expenses, for salaries, utility and rent. So if I were to have it, I can have it like this, minus, right? This one is also a minus. This one is a minus. So I can have it like this, total revenue minus all my expenses. Okay, should be 44. Right, so here is actually, should be from here, 44,460. Okay, so this is how you get your profit. Right, Alright, so far you are following how I do my SOPL. So, but this one is based on the trial balance before adjustment. So when we do the adjustment, right? So when we do the adjustment, for example, according to A contract, consulting fees received in advance that were earned in January A total to 13,500. So now you know that the consulting fees received in advance earned in January 13,500. So what you have to do is that now my unearned fees now reduced by 13,500. But now I have a revenue increase of 13,500. So that's why I want you to see how the adjustment is reflected in your account. Okay, so initially you have unearned revenue of 70,500, but now you recognize the revenue amounting to 13,500. So initially it was unearned, but now it's earned 13,000. So you reduce your liability. Now you recognize your revenue. Okay, and the company paid in advance of advertising November 1st. All right. November, the company paid in advance. Yeah, so that is for 5 pay in November. So you have to identify for January. For January, so you only want balance as 31st of January. All right, adjusted one. So you only adjust for 1 month. So how much is the prepaid advertising that you have to adjust? All right, maybe you paid 7,560. How much is the advertising here? 5 months. November 1st. $7,560. So this is January, September, November, October, November, December, January, February, March. So you have that 7,560 to be over 3 months period, January, February, and March. Right, so you're going to reduce your by 2,520. 7,560 is for January, February, and March. So January you use, so that's for 3 months. So 7,560 divide by 3, so monthly 2,520 lah. Right, 2,520, which is balance that you are going to expense during the year. So now you have additional advertising. Okay. Insert. I have advertising. Right, which is amount is 2,520. Okay. This one adjustment I put on a separate column. Right. So I want you to do this first. All right. Whenever you have this kind of question, do the trial balance, put that into financial position. Then only you do the adjustment. Then you look at which account will be affected, which account to be debited or credited, reflected in your SOP and SOPL. Okay. So try this first. I want you to do all the tutorial question. We discuss this in your next class, inshallah. With that, I think it's already 3:24. I think that's all for today. Please don't forget to fill up your attendance sheet. All right, and then we'll see you inshallah next class. With that, Assalamualaikum warahmatullahi wabarakatuh.
Salam. Thank you, madam.
Waalaikumsalam, madam. Thank you, madam.
Thank you very much, madam.
Thank you, madam.
Thank you, madam.
Thank you, madam.